Most people panic when the market crashes. They're selling everything, hoarding cash, and praying they don't lose their life savings. Meanwhile, the smart money is positioning themselves to make a fortune because while your neighbors are watching their 401ks evaporate and financial advisors are telling everybody to stay calm and ride it out, there's a small group of people who understand something that most don't. Market crashes are the greatest wealth transfer events in history. Every recession, every crash, every panic is just money changing hands from people who don't know what they're doing to people who do. The 2008 crash, while the average investor lost 38.5% of his portfolio value, specific investors were buying up assets at 40 to 60 cents on the dollar. They walked away with generational wealth. Today, I'm showing you 5 strategies they used and how to position yourself right now before the next crash hits, okay? This is how you actually profit, guys, when everybody else is out there panicking. Here's what actually happened during 2008 that nobody even talks about. While the S&P 500 dropped 38.5%, real estate investors who had cash were buying foreclosed properties for pennies on the dollar. Tech companies with bulletproof fundamentals, guys, they saw stock prices slashed in half, then they 10x'd over the next decade. The data backs this up. 82% of millionaires surveyed said they built their wealth by investing during downturns, not bull markets. They bought when blood was in the streets. But most people do the exact opposite. They panic sell at the bottom, then they buy back in after the prices recover. They're literally transferring their wealth to people who stayed calm. Now, here's what this actually means for you right now. While everyone's focused on trying to time the stock market, smart money is building assets that generate cash flow regardless of what the economy does. Because here's the reality. There are businesses that don't downsize during recession. Pipes burst, right? Heating and AC units break down. People need electricians. These essential services businesses actually thrive during economic downturns because their services aren't optional. But they need one thing, guys. They need leads. That's where digital leasing comes in. You build simple websites that generate leads for these recession-proof businesses, and they pay you $500 to $2,000 per month to connect them with customers who need their services. I built a portfolio doing exactly this that brings in over $41,000 per month. My students are making $2,000 to $6,000 a month with the same system. It's the same wealth building principles, guys. Own assets that produce income, but you're doing it with digital properties instead of physical real estate. Click the link for the free training. All right, let's break down these 5 strategies that actually make money when markets crash. Strategy number 1. Value stocks at deep discounts, right? When markets panic, guys, quality companies get thrown out with the garbage. So you're looking for businesses with strong balance sheets, low debts, and products people actually need. All trading at 40 to 60% below the value that it's worth, right? During March 2020, companies like Microsoft and Apple, they dropped 30 to 35%. Anybody who bought at the bottom saw a 300% plus return within just 2 years. Value stocks historically crush it during the recoveries, right? A study from 1926 to 2019 showed they returned 142% in 3 years following market bottoms, right? Compared to 89% for growth stocks. On the flip side, guys, avoid value traps, right? A stock at $2 isn't a bargain if it's headed to bankruptcy. Look for consistent earnings, minimal debt, and products people need regardless of the economic condition. Strategy number 2, real estate at distressed prices. Now, here's where most people this up with real estate, okay? They think you need perfect credit and 20% down to make money in property during the recession. But that's not how smart money does it. After the 2008 crash, investors who bought foreclosed properties between 2009 and 2011 saw an average return of 186% by 2019. They bought when everybody was terrified of real estate. While your neighbors were walking away from underwater mortgages, these investors were buying properties at 30 to 50% below market value. You don't even need to buy single-family homes. Commercial real estate gets absolutely destroyed during recessions. Office buildings, retail spaces, small apartment complexes, all trading at massive discounts because businesses are failing and vacancies are extremely high. During 2008 to 2010, commercial properties in secondary markets were selling for 40 to 60 cents on the dollar. A strip mall that was worth $2 million in 2007 sold for $800,000 in 2009. Investors who bought these properties collected rent through the recovery and sold them for 3 to 4 times their purchase price by 2015. So why does this matter? Real estate is one of the few assets where you can use leverage, right? You can put down 20 to 30% and control an entire property. When that property doubles in value, you're not making 100% returns. You're making 300 to 400% returns on your actual cash invested. On the flip side, you need to understand cash flow. Don't buy properties that bleed money every month, hoping for appreciation. Buy properties where the rent covers your mortgage, taxes, and maintenance, right? That way, even if the market takes longer to recover, you're not hemorrhaging cash while you wait. Strategy number 3, buying recession-proof businesses. Warren Buffett has a famous quote, guys. It's be fearful when others are greedy, and greedy when others are fearful. This is exactly what he did with businesses during the market crash. He didn't just buy stocks. He bought entire businesses at discounted valuations. And here's the thing, you don't need billions. During recessions, small business owners panic. They're over-leveraged and desperate to sell. You can acquire profitable businesses for 2 to 3 times earnings instead of the normal 4 to 6 time multipliers, right? Essential services like HVAC, plumbing, and electrical saw revenue dips of only 8 to 15% during 2008. Compared to 40 to 60% drops in luxury sectors. So why does that matter? You're buying a cash-flowing business cheap. It keeps generating money because people need essential services, right? And when the economy recovers, your business value doubles or triples, okay? Now, here's the thing. This is exactly why I focus on digital leasing. Same concept, but without the overhead, without employees or physical locations. You're building digital assets that generate leads for recession-proof service businesses, and they pay you every single month. You're not buying an existing business with all of its baggage. You're creating a brand new digital asset that feeds customers to businesses that need them. Strategy number 4, precious metals. Here's what most people don't understand about precious metals during recessions. They're not just safe havens. They're insurance policies that actually appreciate. During 2008, when the S&P 500 was down 38.5%, gold climbed from $869 an ounce to over $1,200 an ounce by the end of 2029. By 2011, it hit $1,895. That's a 118% gain while everybody else was still recovering their losses, right? Silver, guys, it moved even faster. It went from $9 per ounce in 2008 to $48 an ounce by 2011. That's over 400% returns for people who understand the play. And that leads us to why this works. When governments print money to fight recession, inflation follows, right? Precious metals are real assets that can't be printed. Their value increase as currency loses purchasing power. On the flip side, don't go all in on metals, okay? They should be 10 to 20% of your portfolio max, right? Think of them as your insurance, not your entire strategy. You want assets that produce cash flow too, which metals don't do. Strategy number 5, bankruptcy sales and liquidation auctions, guys. Now, here's the strategy that sounds dark, but it creates serious wealth. Buying assets at bankruptcy and liquidation auctions during recessions. When businesses fail during economic downturns, they liquidate everything. Commercial equipment, inventory, real estate, vehicles, right? All of it gets sold at auctions for pennies on the dollar because they need cash immediately. During 2008 to 2010, commercial restaurant equipment was selling at auction for 20 to 30 cents on the dollar. A $50,000 industrial kitchen setup would go for $10,000 to $15,000. Buyers would either use it in their own restaurants or resell it for 3 to 5 times what they paid for it. Manufacturing equipment, office furniture, even entire warehouses of inventory were just being dumped. So smart buyers were attending these auctions with cash. They were buying assets at liquidation prices, then either using them in their own businesses or flipping them when the economy recovered. So why does this matter? Well, you're buying real tangible assets that have actual value for a fraction of the replacement cost. A construction company going bankrupt sells excavators worth $200,000 for $60,000. You can lease that equipment out or use it to start your own operation. You need to know what you're buying and have cash ready though, right? These are cash only deals usually. Do your research on the asset's actual value, right? Inspection, the condition, and market demand at the time, right? The opportunity is massive, but you can't just wing it. So let's tie this all together. Every single one of these strategies has one thing in common. You're buying quality assets when everybody else is panicking and they're selling, right? Value stock trading below value, right? Real estate at 30 to 50% discounts. Recession-proof businesses for 2 to 3 times their earnings. Precious metals as insurance against inflation for you, right? Liquidation assets for pennies on the dollar. The wealthy understand that recessions are wealth transfer events, guys. Money doesn't disappear. It changes hands from unprepared people to prepared people. The question is, which side are you going to be on? Now, here's the reality. Most of these strategies require significant capital. You need cash reserves to buy distressed real estate. You need money to acquire businesses. You need funds to attend liquidation auctions. But there's one recession-proof strategy that doesn't require massive upfront capital. Building digital assets that serve the same essential service businesses that I've been talking about. The plumbers, the electricians, the HVAC companies that need customers regardless of what the economy does. If you want the fastest path to recession-proof income, build digital assets that generate leads for service businesses. They'll pay you $500 to $2,000 per month for consistent lead flow. I built a portfolio of digital properties that bring me in over $41,000 per month. I've got students making $2,000 to $6,000 a month from digital leasing. Building simple websites that rank on Google and send leads to these local businesses. Click the link for the free training. I'll show you the exact system and how to get your first client this month. Stop betting on the stock market. Let's go build something that lasts.